This is a disaster. I spoke the whole time, which was a very important aspect of income statement, and that was not being recorded. Ah, but anyway, it's in the main lecture. We have main lecture, so just- oh, thank you for reminding me. But what was all this time? I mean, at least it's not wasted. You guys all understood, so that's what's important. All righty, so let's take a 10-minute. All right, we're back. We're back. So uh, I'm just just feel so foolish about not uh, not hitting the start recording button at the beginning. So we um, the whole hour and probably the whole hour and 7 minutes we had the discussion of and for the whole hour and 7 minutes. That portion was lost, because it wasn't being recorded. But I hope everyone was listening and very carefully and attentively. And as far as I can see, the majority of you have understood, followed, and understood. So we are moving on to the next. So we now understand, how what inventory is and how inventory is expressed in the income statement. If it is retail and if it is manufacturing. And the next thing is promissory notes and accounts receivable. Okay. Uh, as for cash and cash equivalents, I told you there is a link. I mean, I just to save our time, save on our time, I provided a link there, right, in the topics folder. And if you click on it, there's a video about it, and it's very useful video. And the bottom line is, cash equivalents are like uh, the balance in checking account and short-term money market instruments that has very high liquidity, like cash, and that can be that doesn't lose value over time. I mean, whereas uh, marketable securities generally refer to long-term debt, right, like bonds and stocks, and they can lose value because they over time, stocks lose value, uh, or gain value. In other words, the value of the purchasing power of these assets change, constantly and frequently. Whereas, marketable securities, I mean, nominal value, at least uh, uh, nominal value of the cash equivalents uh, hardly changes. Okay. Now, promissory notes. What's promissory note? Promissory note is a IOU. It's a short-term. So it's a short-term debt because promissory note is literally promise to pay. Promise to pay is IOU. So people easily think, oh, so IOU, I can write an IOU. I borrow some money from a friend or family and write IOU. So, oops, why am I? Can I write? Yes, between friends and family. I mean, trusting friends, and you can borrow $1,000 from a family member or trusting friend. And if you are not very credible person, I mean, you're not very trustworthy person, then friends and family will just lend you money without thinking that you will get it back. They will get it back. But usually, that's the maximum. In other words, that's the most extensive boundary of network of people um, you can borrow from. But you cannot write on you cannot go to an Apple store and buy an iPad and pay with an IOU. It's unacceptable. Why? Of course, it's unacceptable because um, who knows? I mean, who Apple Store doesn't know you. I mean, they will have to run your background check. But in B2B, this is mostly B2B, business to business, right? In other words, within the channel members, right? Between the manufacturer and wholesaler and retailer, and between the wholesaler and retailer, they use promissory notes very often. So promissory notes look like a check. They basically, it looks like a check, and then it's got dollar amount on it. Of course, you just write a dollar amount just like the check, but the difference is that they have interest rate and maturity, right? They have interest rate and maturity date on it. And XX ink. It's printed, of course, just like a check. It's printed. So and it's only the maturity is within 1 year. I mean, less than 1 year. I mean, it's a short-term instrument, short-term, and in general, maturity on the promissory note is most of the times less than 60 days. Less than 60 days, right? And of course, that means, it could be nobody would write promissory note just to pay it back the next day. I mean, it cannot be like 0 or 1 day. Usually, anywhere between. The reason you are paying with promissory note is to buy you time, right? And you usually between 30 to 60 days, and most so between Dell. Let's go back to our Dell and uh, Best Buy example. So Best Buy buys 500 computers from Dell or 1,000 computers from Dell, and if it is 1,000 computers, they will pay probably 200K, right? The dollar amount will be 200K here. Uh, and 60 days, right? With 60 days at, let's say, 5% interest rate, 5% APR. Now let's think about it. Okay, excuse me a second. Wait a minute. I'm gonna. So then think about it. What is the benefit of this? From Best Buy's perspective, right? They can have use of 200K for the next 60 days, meaning for the next 60 days, you might think, if they have to pay eventually, why don't they just pay upfront? No. Uh, what if they can put this money, 200K, into a stock, that has the expected return of that has expected return of 10%. Of course, all the percentages, all these rates are annual, but let's um, say, just to make it simple, let's just, even for 60 days, let's say it's 10%, 5%. But obviously, we know why they do this. They can put 200K and into this stock and earn 20K, right? Earn 20K, 10%, and then 5% on this is 10K. I mean, think about it. You can, an expected return means, on average, it earns 10%. So most likely it will earn 10%. Then by buying time for 60 days, they can earn 10%, which is more than enough to pay for this 5% interest on the promissory note, right? And still have 5% left for themselves. And for Best Buy, if they, I mean, for Dell, if they defer the payment for 60 days, if they defer it for 60 days, they don't have 200K for 60 days, but instead, they will have, they will earn 5% on this, right? By waiting for 60 days, they earn 5%. So they have, and if this is better than the bank interest rate, then why not? I mean, that's a compensation. Basically, that interest rate is the compensation for that, uh, uh, for that wait, for not having 200K. If they receive 200K on day one, right? I mean, at the time of the purchase, then and if they knew about this stock, then they can earn 10% themselves. But that's not up to them. I mean, think about it. In B2B, buyers are usually the one. Uh, Buyers are usually the one that calls the shot, right? Buyers are the ones that usually calls, but sometimes sometimes it can be the other way around. And you know what buyer's market and seller's market um, is, right? What's the difference between buyer's market and seller's market? But think about it. If the buyer is a industry giant, if the buyer is a main player in that industry, buyer calls the shot. If the seller is the major player in the industry, seller also calls the shot. I mean, it depends on how big and how dominant they are in their own industry. So, for example, Dell is a computer manufacturer, right? Uh, and Best Buy is a retailer. I think Dell is a much bigger company than Best Buy. But Dell is a manufacturer and um, Best Buy is a retailer, so they must cooperate. I mean, what's in the best interest of Best Buy is also in the best interest of Dell because, but Dell also has Dell. In reality, Dell does the direct marketing. Dell sells directly to the end user. Dell is both B2B and B2C market, right? Um, um, but then, in the old days, when manufacturers did not have uh, like distribution network. I mean, there was no way they can access uh, the consumers directly. Then they had to go through the middleman, right? So they had to. Uh, I mean, they are basically, in collaborative relationship. They have to collaborate. Um, Cooperative. They had to cooperate. They had Um, but then uh, Best Buy, since Best Buy has, Best Buy is directly interfacing directly with the consumers. Uh, Dell cannot upset Best Buy. I mean, think about it. It's only detrimental to them if they upset the retailer, right? Although Dell must be a much bigger company. Dell isn't going to say no when Best Buy wants to pay with promissory note. Uh, Dell won't say no, right? Dell won't say no. But they had to. Sometimes the interest rate, uh, sometimes the interest rate may not be even a bank interest rate, and still they won't say no. They cannot say no because it's better to have the retailer on their side, working with them, rather than having them as enemy, right? Obviously, manufacturers, no manufacturer wants to have retailer as an enemy. No retailer wants to have a manufacturer as an enemy. Um, Also, Dell is as a manufacturer, but Dell can be also a buyer. Think about it. Dell doesn't make everything themselves. Microchips, the semiconductors, right? CPUs, the parts and components. They also outsource them. They outsource these components, right? And chip makers like Intel, AMD, Nvidia, especially these days, the chips for gaming are very hot. The chip market for gaming industry, gaming devices, game devices. Uh, so these, think about it. Intel is also Samsung and Intel, Hynix, all these chip makers. They are also AMD, Nvidia, or TSM. I think that's Taiwanese chip maker. They are huge companies as well. They are probably bigger than and more dominant player in the market than Dell, because nobody can make computers if Intel doesn't want to sell chips to them. But again, Intel wouldn't do that because that's a bad business for them, right? They wouldn't dig up their own grave, by turning against, by upsetting computer manufacturers. So they are all in cooperative, because they are in uh, uh, chain, supply chain. All they are all channel members. So Dell can also buy chips from Intel by issuing promissory notes. And so the promissory notes are, from the seller's perspective, if possible, they don't want to take promissory notes, but uh, they will. And they want to collect, if possible, they want to collect it on average. This is in just the industry average. I mean, common business practices. They want to collect it within 45 days. Most of the businesses want to collect it within 45 days. So that means, if they wait 60 days, they will collect it. Uh, Dell presents this promissory note to Best Buy and collect 200, and it's 5%, so 201K after 60 days. Okay, but then this is the case. I mean, they can wait. If these are big businesses, big companies, they can wait until maturity. They, because big businesses, big companies have relatively, better cash flows. They are in better cash flow situation. But if it is a small company, the cash flow situation is not that good as Dell. And I've been Dell. I told you Dell can be also the buyer because they buy and uh, microchips are generally manufacturers of microchips are big companies. But what about something like a keyboard? Hmm? Small, keyboard, mouse, speakers, external speakers, I mean, computer peripherals, those, I mean, there are these are very small manufacturers. And the small manufacturers generally are not, uh, they sell to Dell, but they are not generally in good, their cash flow is not generally good. The cash flow situation is not that good. Small businesses are always tight with cash. They are very tight with cash. Small businesses are tight with cash. So they cannot wait 60 days. I mean, if they wait, for example, they sold, and uh, let's say they sold, $50,000 worth of mice to Dell, and if they wait 60 days, let's make it 100,000. Let's just to make it easier to. So they sold $100,000 worth of mouse to Dell, but they cannot wait 60 days because their cash flow is not that good, and they have payments to make. They will have to make, this mouse company will have to make, they have accounts payable, right? Accounts payable within 30 days. They have to make 100K they have accounts payable that mature in 30 days, meaning that they have to make this payment in 30 days. But they don't have, cash flow, and they cannot. But they have a promissory note. They have promissory note, but they will have to wait 60 days. But this means nothing. I mean, they cannot pay if they hold it for 60 days, but they cannot use this to make the payment, then they go bankrupt. In other words, a default. They default on this. Default can lead to bankruptcy. So this is a very difficult situation. So do they have to wait 60 days? No, they don't have to wait 60 days. They don't. This is what This is why there is financial market. There's why there is money market. What they can do is they can take this. They can hold it for 30 days, or they don't even have to hold it for 30 days, but they can, the minute they receive this promissory note, they can take it to, what's going on? They can take it to a bank or a third party financial company who specialize in promissory notes and accounts receivable. That means, so 5%, right? The interest on this promissory note is 5%. Let's say they were able to hold for the first 30 days, but then they cannot hold it for the next 30 days because they have, let's say they have payments to make on day 40, right? 40. They have payments to make. So they have to have cash on day 35. Then what do? They will have to cash out in advance, but they cannot cash it out from. They cannot cash it out from the from Best Buy or from Dell. They will cash it out from the bank or a financial company. Okay, so then the face value of this promissory note is 100K. Face value, and interest rate is 5%. So what is the maturity value then? What's going to be the maturity value? In other words, if they waited for 60 days, the maturity value will be 100K times 1 plus 5% over, I'm sorry. 5% over 60 over 360. Now think about it. 5% is APR, right? 5% is annual, right? It's APR. And the maturity is 60 days. So you just need to make an adjustment for that. And you've seen this before. This is simple interest rate method, simple interest rate. Okay? I told you there's compound interest rate and simple interest rate. Compounding we already understand. Compounding is used for long-term capital market, and the simple interest rate method is used for short-term money market. Making adjustment. I mean, if it is annually 5%, then for 60 days, it's only this. Isn't it right? And you might wonder, why 360? Isn't it 365? Yes, there are two ways. One is called, type of, interest year. There are two for that. One is ordinary interest year, which is 360, and then there is exact interest year. Exact interest year is 365. But unless otherwise specified, unless it is clearly stated in the problem that to use exact interest year, but default is always ordinary. That's why it is called ordinary, right? So if we make this adjustment, right? Maturity value will be using, simply using the calculator. So 100 100,000 times, open parenthesis, 1 plus 0.05, that's 5%, times 60 over 360. You might wonder, isn't it better to use, exact interest here? No, I mean, if you are the one receiving money, it's better to use smaller denominator than bigger denominator. Always the fraction gets bigger. Always the fraction gets bigger when the denominator is smaller. And if you are the one receiving the money, then you would prefer the fraction to be bigger, not smaller. If you are the one paying money, you would want the fraction to be smaller, right? You would prefer. So it's going to be, so it's 100,833.33. Then it comes to 100,833.33. This is if you are holding it until maturity, right? If you hold it until maturity, and present it to Dell, you will receive this. But you cannot hold on to it 60 the full 60 days. So what do? You took it to the bank or a financial company on day 30, and then what they will do is they will discount it. They're not going to do it. So think about it. You take it to a bank on day 30, that means day 0, day 60, you were holding it for half the time. But then after that, they are taking over the risk. Isn't that right? The bank is taking over the risk. So they won't do it for free. I mean, and the risk is what? It's a default risk. Isn't it right? It's a default risk, Although it is, in our example, it is Dell. Dell is not going to default on their promissory note, but it's not always Dell. It could be, some company that is, not very steady. It could be a company that is going through some, financial difficulties, so if the bank buys this, then they are taking over the risk. And think about it. In this case, this company is selling it on day 30, but this doesn't have to be day 30 only. What if it is, day 10, right? The risk is greater for the bank. Isn't that right? So the bank will have to make adjustment for that. So bank isn't going to pay this company this entire maturity value. Instead, they are going to make adjustment to that maturity value. They will apply. So here's another concept. So they will need to discount the maturity value. They will discount it by applying some discount rate times the time remaining. In other words, in this case, if this company is if this company took the if this company is selling it on day 10, will be 50 days left, right? So let's call this uppercase T, right? Uppercase T, and then call call this T0, and let's call this T. So then small case t, right, time to maturity, is t, I'm sorry, this should be called t1 because t0 is, this is t0, always the beginning, right? It's t0, so this must be t1. So uppercase T, the terminal time, minus t1, that should be t. And in this case, that's so you will divide it by 360 or 365. Okay, so in our example, maturity value, MV, here, MV. And they will, let's say the discount rate, they will apply the discount rate of, usually they will apply higher discount rate. Discount rate is usually, they will apply higher discount rate than the interest rate on the promissory note. So let's say the discount rate is, interest rate was 5%. So let's say discount rate is 8%. They will discount it deeper. By discounting it deeper, they get more, right? They will get more. The bank will get more. So in this case, 0.08 times, that will be 50 days out of 360. Okay. Now this is called, so for example, it's like, if you think about it, it's like interest splitting. The rationale is, now let's think about it. I'm gonna have to type. So look at this timeline. You are that small company that sold mouse to Dell, and you received the promissory note with 5% interest, maturing in 60 days. So then, the maturity value of your promissory note is this, but you held it for the first 10 days. You're holding it for the first 10 days. Then, wouldn't it be nice if the bank gives you the principal, 100K plus the interest for the first 10 days? Because they were taking the risk. This company was taking the risk for the first 10 days. So interest is the reward for taking the risk, right? So if they took the risk for the first 10 days, which is 1/6 of the total period, they get compensated for that, and then the bank will hold it until the bank is holding it for the remaining 5/6 of the period and get compensated for that 50 days. So in other words, then on day 60, it's not this company who received the promissory note, but it is the bank that will present it to Dell, right? It's the bank that will present the promissory note to Dell and collect the maturity value of 100,833. But they have already paid them something on day 10. Whatever is left is their cut, right? So that's why they want to think about it. If they apply the same discount rate as the interest rate, it will be split. The amount will be split exactly by 1/6 and 1/5. But then that seems very fair, but banking is not a fair business. Bank wants to skew it more to themselves. Any business will. It's more, as I told you, insurance company isn't going to pay you the full value of your car. They will try to, right? They will try to pay as little as possible. Of course, there are some, good insurance companies that will apply fair valuation. But for example, if your car has 10,000 miles on it and 1 year old, they will some insurance companies pay the median used car value under the same conditions, 10,000 miles, and that median value would be something similar to what you would find on Kelley Blue Book as median value. Some insurance companies will do that. They will be, fair and honest. But most insurance companies will try to give you the bottom value, the lower end value. Just like that, most banks will try to skew this split. You understand? Most banks will try to skew this, split more in their favor. And then if they use the same interest rate, same discount rate as the interest rate on the promissory note, it will be split just by this ratio, exactly fairly by this ratio, 1/6 and 1/5. But they want to skew it more to themselves. So that's why then they discount it deeper. That's why they use, that's why they use, bigger discount rate than the interest rate on the promissory note. And let's, do this calculation. So this was the maturity value. So we multiply it by, open parenthesis, 1 minus 50 days, discount rate first, 1 minus 0.08 times 50 days over 360. The factor is like that. That's the factor. Then, yeah, it will be 99,000. It was 100,000, right? Official 99,712.96. So 99,712. So $99,000 712. What is this? This is what you get. In other words, you sold this promissory note. You sold this promissory note to the bank with 50 days left. 50 days left. Then the bank buys it for this. In other words, they pay you this, right? They pay you this. And then the difference between the two. And then the bank will hold that promissory note and present it to the issuer of the promissory note on the maturity date. And then they will collect 100,833. And then the difference, so this is called D. What does that stand for? That's called proceeds. That's called proceeds. In other words, from the sale of this promissory note to the bank on day 10, with 50 days left, the proceeds from that sale is 99,712. Okay, and the difference between the maturity value and this is called a bank discount, simple discount or bank discount. So the difference is called B. The B is the difference between bank discount. It's the difference between the maturity value and the proceeds. So that's called bank discount. That's what the bank takes. That's the bank's cut. Okay, and it's also called simple discount because we use, they use simple interest rate method, right? And this is all. Think about it. Simple interest, and I told you when we were talking about simple interest rate versus compound interest rate, I told you simple interest rate is used only in the money market, short term. So basically, it's not. You don't use, simple interest rate for maturity longer than 1 year. So everything is like on, how many days, and you just simply make the annual rate for that factor of the days, number of days out of a year. So everyone is clear about this? Everyone follows? I think
yes,
Kyle,
that's correct. Yep.
Yeah.
All right, good. I think, okay, Kyle has very poor connection, it looks like. So this is why, this is promissory note. And another thing is, this is also how the accounts receivables are discounted or factored. Now, here's the term factor. So I told you the company, this company takes it to the bank or a financial company, and the financial companies are specializing in factoring promissory notes. I mean, I use the term factoring. What? This is factoring. Simple discount is called factoring, and these are called factors. These financial companies are called factors. Factors. Okay. Why is it called factor? I mean, why is this process called factoring in the first place? Why is it called factoring? Some people think, oh, because you are discounting it by the factor of 50 over 360, or no, not because of that. Not because of that. So anyway, the bank makes this, that's the fee they take, the difference will be like, pretty much about $1,000, slight, but that's the That's the fee reward for taking the risk. That's the fee for taking the risk. And why is it called factors? Actually, uh, factor means it comes from the French and other European languages. In French, there is a word like la facteur, and in Italian, I think it is like fattore, Italian. Il fattore, I think it is. Italian. El fattore. Spanish, probably la fattora. And you might say, oh, what that means is they all mean invoice. Invoice. And then even in Czechoslovakian, Czech, I know this because when I went to Czechoslovakia and I rented a car, and when you rent a car, of course, you pay with a credit card. You pay with credit card. Mm-hmm. So it's already prepaid, and you have the receipt, your credit card receipt. But at the end, when you return the car, I received a factura or factur or something like. It's not a Romance language. Czech is Slavic language, so obviously these are all cognates, right? Because they are Romance languages. You know what cognates are. They share the roots, but Czech is a Slavic language. They don't have any common root, but they still use the term. And when I returned the car, I received factura. Of course, that doesn't mean pay this, because I already paid. But it's just a formality. I mean, that's what the business. When you buy something on eBay or Amazon, right? You pay with already your credit card. But when the goods are delivered, you will in the package you see an invoice, right? You see an invoice. It's just a formality. I mean, that means they are requesting the payment on that. But then it's already paid, so it doesn't mean anything. But the point is, in B2B, there's a lot of credit sale. Think about it. In B2B, so here in our example, the mouse, right? In this case, mice. 1,000 mice, 1,000 mice. In case of promissory note, Dell approached this company and bought 1,000 mice. So, and then they paid with promissory note. So it's like a credit sale because they paid with promissory note. It's like a credit sale. Credit sale initiated by the buyer, by Dell. But sometimes in B2B, between the supplier and manufacturer, there is like a 2-year contract. I mean, you will be my sole supplier, sole distributor. I mean, there is sole distributor, agreement, and sole supplier agreement. You will be my sole supplier for the next 2 years, so or next 5 years. By locking into a long-term contract, then there will be a discount. I mean, if you like this company, company M, company X or M, makes computer mice, and Dell like it because it's high quality and reliable. Their production, I mean, they never disappointed. Um, they met the production schedule all the time. Oh, then we will, and quality is high. Good company. So we will use your mice all the time. We will use your mice. So then give us like 10% discount every time. Yeah, well, this company would like it. I mean, it's a steady. Dell is a big company. It's a steady source of income for them. Steady source of order, right? They will have, and then between the two, and when Dell has a production schedule, it will be automatically, their computers will be online. It will be automatically transmitted, notified to this company X, and they will automatically. So if their production schedule is, uh, uh, if their production schedule is like 1,000 units, 1,000 computers, then they will need 1,000 mice. They will ship without, then Dell wouldn't have to place an order because they're already on, supplier contract, a 5-year supplier contract. Their computers are online. They will be notified automatically. Then they will ship it automatically. 1,000 mice, they will ship it automatically, right? And then with that shipment, the invoice goes there. And there are two copies, original invoice, copy of the shipper and a copy for the customer. I mean, in two copies of invoice always, right? You understand that? When you ship something, the shipper retains one copy of the invoice, the original, and the merchant's copy, that's, and the customer's copy, right? So then think about it. This invoice is the proof. This invoice is the proof that the company X has claim. So if 1,000 mice each, and that's what? How much was that? 200? I don't know. I forgot. Each mouse is $20. If each mouse, is it? I don't know. $20. 1,000 units. The invoice amount will be $20K, right? If each mouse is $20 per unit, right? The invoice amount is $20K then. Now think about it. They will need to collect this $20K. Usually they give like 60 days or 45 days, but whatever it is, they give 60 days to pay. But then let's say Dell is a big company, so they don't generally run into a cash flow problem. But mouse manufacturer, they're a small company, they can easily run into a cash flow problem. So then what do? They don't have to wait 60 days to collect it. They take the invoice to a factor, right? A financial company. They take this invoice to the factor, right? To a bank or to a financial company, and then they sell this invoice. So the same thing happens, just like the promissory note. They will get it discounted. That's called factoring. They get it discounted. That's what the factors do. That's what the factors do. They get it factored. Hence factoring. They get it factored. They get less than the invoice amount, but they get the money right away, right? They get the money right away, and the factor, the financial company, will get it, the 20K from, they will collect it from Dell. So now you understand why it is called factoring, because it started as selling invoice. It started, the term started, and the term for invoice in those European languages are like this: in French, la facteur, il fattore in Italian, la fattura in Spanish, and even Czech. German and Russian is different, they are, I looked up, but in Czech, factura. So the word factoring means selling invoice. It comes from the word invoice. So you cannot, invoice is what? You know what invoice is? In this, I already have it. So accounts receivable, that's invoice, right? Invoice is what, if you're the seller, the supplier of mouse, your accounts receivable, is invoice. The physical form of accounts receivable is invoice. Think about it. Accounts receivable is nothing but a concept, isn't it right? Accounts receivable is a notion. Accounts receivable is a notion. Accounts payable is also a notion. It's nothing but a notion, right? It's nothing but a notion. What is the physical form of that notion? What is that physical counterpart of that notion? The physical counterpart of that notion is accounts receivable. Make sense, everyone? Does it make sense?
Yes, yes.
Yeah.
Okay, good. So that's, now that's everything. That's everything. You can do your quiz 1, which is due today. You can do it now. You can do it. I mean, you may have already started. You can, but it's only 2 hours. If you have started, you must have finished already. All right, that wraps up everything about topic 2. We're gonna move on to topic 3 tomorrow. Any questions now? Any further questions? Any further questions? Any further questions? All right, if there are no more questions, I'll call it a day here. So have a great afternoon, everyone. Good luck with your quiz 1, and I will see you tomorrow. Okay, I'll stop sharing, stop recording, and sign out.
Thank you,
All
Professor.
right. All right. Take
Thank
care,
you,
everyone.
Professor.
Take care, everyone.